Trading futures and options on futures involves substantial risk of loss and is not suitable for all traders and investors. Oftentimes in futures trading, you have a high combination of leverage and volatility. And although this could be an equation for opportunity, it's also an equation for risk. So be careful. Only fund your futures trading account with risk capital. My personal definition of risk capital is money I could afford to lose, doesn't change my lifestyle, or overly stress me out. As human beings, we make bad decisions when we're under stress, so be in a good spot. Remember, micro contracts could be friends. Take it easy on the day trade margins. You get plenty of leverage without maxing out on those day trade margins on a regular basis. We'll be taking a look at a real-time simulated live NinjaTrader trading platform today, and none of this should be construed as trade or investment advice. Past performance not indicative of future results.
Well, good afternoon, good morning, good evening, and welcome to Technical Analysis Explained. I'm your host, Tom Schneider, CMT with NinjaTrader. And on Technical Analysis Explained, we like to take a little bit of a deeper dive into a single concept in technical analysis that might help you understand the markets a little bit more. So it's really my pleasure this week. We have a guest on the show. We don't always have guests, but this week is a little bit different. We have a great guest on the show, and I've worked with this guest in previous incarnations in the past, and just a great guy to have on the show. I'm very thrilled to have Dave Keller, also a CMT of StockCharts.com. He's their chief technical analyst there. Welcome to the show, Dave.
Good to see you, Tom. Good to see you again. How are you?
I'm doing very well. How are you doing?
I'm well. Yeah, good to be on the show, and thanks for inviting me.
Oh, my pleasure. It's such a thrill to have you on and to be talking with you again. And for those of you viewers who are new to technical analysis, I mean, you couldn't have a better tutor than Dave. I certainly learned a lot from Dave when we worked together many years ago. And so it's, again, like I say, it's my treat to have you. But for those who don't know, where are you located, Dave? We're certainly in different places. I know that.
Little bit, right? So I'm in the Pacific Northwest in Redmond, Washington, just east of Seattle.
Oh, that's great. I know you move around. I've during your career, your storied career, you've moved around a bit, and beautiful place. I've been up there. It's beautiful, beautiful country.
No, it's a gorgeous area, and people should know that one of my favorite ways of interacting with you, Tom, over the course of my career that's gone from New York to Boston to Cleveland to now Seattle, is checking in with you for the update on the local baseball team. Who I should be following. So the moment I moved out here, I don't know if you realize this, but we talked recently and you said, yeah, Julio Rodriguez. And the fact that out of nowhere you could come up with the up and coming Mariners star out of any of the MLB teams really speaks to the depth of your knowledge of baseball. So thank you for that.
Well, sure. And you know, I go back to when you were in Boston at Fidelity, yeah, and we did get to enjoy a Red Sox game, and I haven't seen many at Fenway. That was certainly fun, but we're here to talk about a great topic, and this is a topic that I've seen you speak on, not just to me, not in person, but to a whole group. But before we do that, I do want to get how did you get into technical analysis? If we talk about that.
Yeah, so I have sort of a non-traditional background of being a liberal arts major. So I studied music and psychology as an undergrad at the Ohio State University. And as we were talking before that we went live here, the cyclical income stream of a working musician was really awesome and really painful, and that cycle continued. So I was ready to sort of get a more consistent stream of income, and somehow found a financial firm, Bloomberg in New York, who would hire liberal arts majors and teach us about investing and teach us about the markets, and then rely on our ability to speak and ask questions and be good listeners and help our customers. And that's where you and I overlapped, really, was our time at Bloomberg. And what happened was I arrived at Bloomberg in New York in June of 2000. So my introduction to investing was literally watching the tech bubble burst before our eyes. I was taught about technical analysis when the most successful users and clients that I worked with were the ones that were very chart-oriented and saw clear signs of a market that had been going higher for quite some time and now was no longer going higher, and recognizing that shift. And I think that lesson has stuck with me. So I learned about technical analysis. I kind of fell in love with the idea that you could think about investor psychology and quantify that. And it has a statistical side of it, which really appealed to, I guess, the mathematical musical part of my brain. And I was kind of hooked. And from there, I've kind of sort of pushed through a career with different sort of areas of technical analysis. It's been a joy.
Well, and I say the only one thing I could say that's not positive is the Buckeyes, the Buckeye piece, right? I too had a similar path, liberal arts, Big Ten, got into technical analysis a little bit, probably around the same time, but at a different firm. But I too started at Bloomberg right before a big crisis, right? 2007, 2008. And that's when we met, and that was certainly when markets show signs of stress. That's where I see the fundamental guys starting to peek over the fence and looking at technical analysis. When volatility increases, technical analysis interest increases as well. So
totally. And one of my favorite quotes, don't confuse brains with a bull market. So when everything's going up, everyone feels like you attribute that to your incredible prowess as an investor, as a trader, right? You're just so good. When the markets start to rotate lower, that's where all the bad habits seem to get magnified. And that's where I find that a good disciplined use of technical analysis can really help you recognize that shift. I think that's incredibly important.
Well, and your psychology background, I think, is the interesting part of technical analysis, right? I like you, like the math part of it, but was very, very interested in the psychology piece. And you had that experience with school. To me, that was the interesting thing about technical analysis was, okay, here are these numbers, here's the data, but it's more than just data, right? It represents people's emotions and reactions and all of that blended into a chart, a number, something that you can see, which is really interesting.
Yeah, so I've gotten to know John Bollinger over time, and actually my time at Bloomberg was provided my first introduction when I had him speak at our office in New York years ago. But when the first time I heard him speak, I'll butcher a quote of his, but he said something along the lines of, the market is not a mathematical problem to be solved. It is a living, breathing organism to be analyzed, or something to that effect. And I remember like that completely hit home for me, because I feel like there's been such a movement just in my time, 23 years in the industry, of going, away from subjective kind of anecdotal, just feel the tape type of trading to more quantitative, algorithmic, systematic sort of approaches. And there are good things about that rotation, but I think what you have to remember is you're modeling people that are making often, emotional and uninformed decisions. And you have to acknowledge that the markets, I think, are still very much driven by that. So any attempt we can use to try to quantify market behavior is really quantifying investor behavior and the behavior of individual traders making decisions. I think the technical toolkit is really designed to help you quantify. There are a bunch of market participants. This is what's happening. And this is when they're changing their mind. This is when they're getting nervous or desperate or euphoric or despondent. I think all of those technical indicators we follow really are representing that sort of extreme mentality.
Well, I like how you phrase that, Dave, technical toolkit, right? And it's not a holy grail. It's not one size fits all. It is really the truest sense of the word, a toolkit. And just like any other profession where you have tools that help you do your job, you have to know which tools to use in certain circumstances. You're not going to build a house with just a screwdriver and a hammer, right? Same thing with technical analysis. You're not just going to use the same indicators or one or two for every market situation. And I think that's why this week's topic is really interesting to me, because it does have that idea of it is a tool, but there are different tools in that subset of the toolkit. So, I think maybe I've heard you speak on this before, and I think you're probably the best one I've heard speak about it. And what we're talking about is market breadth. So can you give your definition of market breadth and how you would explain it to somebody who might not have heard of it before?
Yeah, no, definitely. And I think for people that are unfamiliar with market breadth, particularly if you trade like index futures, some sort of broad market contract, you might not be familiar with certain breadth indicators, which a lot of times are measuring the performance of all the constituents of those indexes, right? So what are all the companies that actually make up the S&P or the NASDAQ or the Russell? And by sort of analyzing those at a high level, you can get some additional color on what's happening with the benchmark. So I would define breadth as participation. You're trying to measure participation of the members of that index or whatever that universe is, to see if it agrees with the overall movement of the market. And in general, right, when you're looking at the NASDAQ and you're seeing the NASDAQ move higher, it would make sense that more stocks are probably closing up than down, right? Because that's what makes the market go higher. It would make sense that the volume is stronger on upswings than downswings, because that represents the buying power that's pushing prices higher. But the reality is that's not always the case. And particularly when a bullish phase gets toward the mature end, right? Sort of the 8th or 9th inning of the uptrend, that's when you start to see conditions change. And that's why I find market breadth is incredibly valuable at those inflection points.
Right. I like to think of market breadth as you're going to the doctor and the doctor takes 20 different tests on your body, right? There's taps you on the knee with the hammer, takes your height, your weight, does all the things I don't even know what they're called, right? But he gets an overall sense of how healthy you are by the results of all of those tests. And a generally healthy person will have good numbers, and maybe not so healthy, you might have not such great numbers. And that's what this is. This is taking the health of the overall index, like you said, by measures of the constituents. Now, what's interesting, I think, for the most part, and why I think it resonates with me so much, is a lot of those measures, not all of them, I can think of one right away that isn't, but most of them are binary, right? They either are bullish or bearish, let's put it that way. It's yes or no. The exception might be the 52-week highs and lows, although you talk to my uncle, it either is or isn't, right? 50-50, right? He's always a 50-50 guy. But that's really, okay, that's a whole different thing. But most of the breadth measures are binary. They're either positive, negative, bullish, bearish. And that's why I think they're a really great thing when you sum that up.
So there are two parts, I think, that make breadth indicators so compelling. I think the binary reading is really important. To your point, I think that's well said. It's either bullish or bearish. And what I love when I'm analyzing the markets, when I'm trading for my own accounts, I like simplicity, because to me, simple means robust. Simple means repeatable. Complicated works really well for a very particular set of circumstances, but the moment the market conditions change, which happen often, all of a sudden our perfect back-tested platform, the system, all of a sudden isn't as successful anymore. And so I find simple, repeatable approaches are the things I tend to gravitate towards. So I like the binary sort of thing. It's either a thumbs up or thumbs down, move on, right? And so understanding the conditions and just when that changes is really important. The other really important part is that breadth indicators, for the most part, are equal weighted, meaning you're counting a number of stocks closing up or down. It's how many names are doing this or have this particular condition right now. And our benchmarks of, by which the futures you may trade are derived are cap weighted. For the most part, they're all market cap weighted, meaning the biggest stocks have an outweighed or an overemphasized weight in the index. So, if you want to know why the NASDAQ has been going up through the end of July, it's Apple and Microsoft and Alphabet and all of those names. Every other name could be kind of flat and the NASDAQ is still going to go higher. If you want to know why the NASDAQ is no longer going up, look at the chart of Apple or Microsoft or any of those names, and you'll see that they're all drawing down. NVIDIA, all these Broadcom names kind of rotating lower. So the biggest names, when they change, can have a big impact. Breadth indicators sort of get away from that bias, that mega cap bias, and it focuses more on the participation of sort of the average stock. And I think that can be really, really valuable in terms of having a more clear picture of market participation.
And that also could present opportunity, right? So, as we're seeing lately in the NASDAQ, and I've got a chart, we can show it in a moment, but, what you have is, because of that non-weighted bias that's in the index, but not in the market breadth, that could provide opportunity to say, look, this index continues, but the market breadth is saying something else. That might be a heads up or a peek ahead, if you want to call it that, to say, I think there's a change coming.
Mm.
Something's in the air that's not right. And then
Yeah.
all it takes is one of those 7 stocks or 10 stocks, whatever it is. And, NVIDIA is reporting earnings next week. I'm trading NASDAQ. I got to know that, right?
Absolutely. Yeah. And I think the other good thing about breadth, it sort of connects you to the reality that an index is really as good as the stocks that comprise it, right? And companies reporting earnings, companies having big news flow, companies having a big gap higher or lower really can affect the index, particularly the larger names. When I'm thinking of the conditions with the NASDAQ in particular, I think the story, through July versus the story in August has all of a sudden changed very, very quickly. And what's interesting about that, I know we're focusing on breadth, but for me, breadth is one of those pillars, right, in your analytical toolkit. You have to think about with other things. Seasonally, August and September, not great. Seasonally, July tends to be very strong. So I'm not surprised that the S&P, the NASDAQ are showing renewed strength, really through mid-July. If you look after then, things started to change. And there's no doubt, I think the character of the market has changed in the last couple of weeks. You're seeing some of the leading names starting to struggle, failing to hold their 50-day moving average, for example. That's causing some downside pressure. When I'm looking at the chart of the NASDAQ here, I think we're looking, what's the breadth indicator here? This is the...
Right. So this is, and Jason, maybe we could take a look at that. Here we have on the top, we have the September NASDAQ, micro NASDAQ futures.
Yeah.
And then below here, we have the number of companies in the NASDAQ overall. So we don't have it isolated to the 100 companies that the future represents, but we can use it as a proxy. It's the number of up issues versus down issues or companies.
Perfect. So when I think of this is sort of the like kind of a raw advanced decline number, right? So on an average day, what's going up, what's going down? And to be honest with you, I think as long as you're using a broad enough universe, so looking at the NYSE, the NASDAQ, and looking at that group of stocks, I think that's a really good measurement. And to be honest, getting away from those 100 mega large cap names is probably a good thing. So, if you look at this, look at how the indicator was sort of through July, where you had a number of days where there's more, gainers than losers. You have a lot of stocks closing higher. You have a lot of green days, just looking simply at the price up on top, because a market moves higher, but there are up and down swings all during that time, right? So you have to remember, markets don't ever move in a straight line. It's sort of, an impulse move sort of in the direction of the overall trend. And then there's a corrective move, a little bit of a pullback. So in June and July, you see plenty of up days. You see breadth conditions on average pretty constructive because you're seeing more stocks going up than down. Now look at what that indicator looks like in the month of August. And pretty much every day you're seeing more down stocks than up stocks because what happens is this is more of a market in distribution. The fact that the price of the NASDAQ is going lower is not just this magical, mystical trend change that's happened. It's because the stocks that comprise this group are going lower on average, right? And even though you'll have a random up day here and there, it's more about looking at the change in seasons, if you will. I think we've rotated from a bit of a summer, if not a fall, of the bull market phase to a little more of a winter here. And I think August and September is the seasonal time when that tends to happen. The way that I would confirm that we're still in a pullback phase, very simply the fact that the price goes down. And I was taught the most important thing you can do is analyze price. And so I think just recognizing the fact that the NASDAQ is no longer going up, that we're in a distribution phase. We keep making lower lows. When we have an upswing, they're short-lived. A number of days just in the last week, you've traded more and closed to the lows of the day. We've had a number of kind of inverted V shapes to the, certainly the afternoon. And I think that tells you that buyers are not coming in and super excited to buy these beaten, these pulled back names. They're using this as an additional opportunity to take profits or to unwind long positions. And I think the breadth conditions so far in August have been fairly negative. So if I'm looking for a tradable bounce, I'm looking for breadth indicators like this to turn less negative. We talked about that binary signal. Flip back to where you see some up days, which shows some accumulation. For now, I'm not really seeing that.
Right. And so just to be clear, these two lines down here represent that breadth. The red line is the number of issues in the index that are down for the day. And this green one is the number of issues that are up for the day. So what Dave is basically saying is, look, beginning of August, we kind of changed the paradigm so that there are more stocks every day in August. There have been more stocks that went down than went up, right? Even in a rally. Now, this rally was very short-lived. It was one bar, and it didn't even really take out a little bit, halfway percent the previous bar, but it certainly didn't eclipse the high, and it didn't really get up to the trend line that you could probably draw. So, that can happen. Maybe that rally is based on the 7 stocks that comprise, half the index, right? Or whatever it is. I'm throwing out numbers here, but they're a big chunk of the index.
Yeah.
And so, there is seasonality involved with that. We even saw in July, we saw a very unique restructure of the NASDAQ. That doesn't usually happen in July, right? Because of the increase in those big 7 stocks earlier in the year. They had to restructure, and that could cause some fluctuation in, well, certainly the price, obviously, but even this, where maybe those managers have to buy some of the other stocks to offset the percentage of cap, their cap weighted 7 stocks. So that might be a little bit distracting, but August is very clear to me that this market breadth measure says, it's not very bullish for the NASDAQ.
No, and again, I think what we have to remember, because the binary nature of a breadth indicator like this, it's sort of, people ask, well, when is it going to turn? I'm less into speculating what future date that's going to happen. I'm happy being patient and seeing when that shift occurs, right? When do you start seeing accumulation as reflected by these breadth indicators? And to your point, we're just not seeing that yet. So keeping an eye on a chart like this to see when you start to see a flip, to see when we're closing more toward the highs of the day and we're seeing more gainers than losers on an average day, this is when the conditions start to rotate. And that shows you that not just short-term traders or long-term investors, but really institutions are rotating to the point that it's caught. The price of a major index really moves when institutions are starting to shift funds around. And clearly they've been going a little more risk off here recently.
So this is just one of the market breadth measures. Do you have a favorite market breadth measure? Is there a go-to? Just like I have usually I look at a chart, I have an RSI on there, right? Or moving averages. Do you have a favorite market breadth measure, Dave?
I mean, to be honest with you, the best thing that I've found is the advanced decline line, and I like looking at it in this way. I'll look at a cumulative version of it sometimes as well, and all that's doing is basically just trying to understand the trend in those things, similar to looking at a daily volume reading and then trying to look at volume trends over time. And I think you can do that visually just by looking, not just at one particular day, but over time. How are those conditions evolving? And I think why the advanced decline data can be so meaningful is because, again, it's based on the individual companies, and it's more of an equal weighted measure of the movements in those stocks over time. And so I think keeping an eye on that is pretty meaningful. The other one that comes to mind is just looking at stocks, looking at the benchmarks, but also individual stocks on whether they're able to hold a key moving average when the market pulls back. The S&P is holding above its 50-day moving average. Less and less stocks are actually able to do so, right? If you think of Apple or Microsoft, they're both below their 50-day moving after being some of the top performing names year to date. So I think we're seeing a lot of individual stocks that are failing to hold a key level of support. The more and more companies and more individual companies that are failing to hold their 50-day, to me, that makes me less confident that the benchmarks themselves are going to hold those levels as well. So, when you think about it, I think, when you're analyzing a futures contract and you're thinking of the S&P as one item and wondering whether or not it's going to hold a 50-day moving average, in my opinion, very unlikely that would be the case, because I've already seen so many individual stocks that have already done this. We've seen this play and it's gone very poorly. And I think that's what drags the S&P below the 50-day pretty soon.
So the S&P 500, we've got 500 or so stocks. It might be 499 or 501.
500-ish.
500-ish, yeah, the S&P 500-ish. I think you can trademark that, Dave. Those stocks, all you're saying, maybe a majority of them or some number of them start to they don't hold, meaning the moving average doesn't hold as support. and they break through the 500, right? And maybe they close below it. Maybe they trade entirely below it. Some will be more advanced to the downside than others. But that's what this breakdown is when the constituents start to do so. And it could be more than 50% of them because of that cap weighted idea that, well, if those 7 stocks that make up a huge part of the index haven't broken yet, it's gonna keep it up there a little bit. More and more of the little stocks have to pull it down. But if that happens, look out.
Yeah, and the numbers. I mean, if you look at the end of July, and I just know this from my own process of just look. I mean, I live and breathe stocks and ETFs on an average day, which we've talked about, Tom. For me, when I look at the reality of the equity universe, at the end of July, it was probably around 90% of the S&P stocks were above their 50-day.
Wow.
Right now, it's probably low 60%. So I would say about 30% of the S&P members were above their 50-day moving average about 2 weeks ago, and now are below their 50-day moving average today. And while that might not seem like a lot, it's actually quite a big rotation when you think about it, right? I mean, that's 100 out of the S&P stocks or so breaking their 50 days. So while the S&P and the NASDAQ like attempting to hold it, a lot of the companies that comprise that index have already broken down there. And it just shows you, again, more of a risk-off rotation where you're seeing, the price goes below the 50-day because there are more sellers than buyers, because there's more, less demand than supply, however you want to think about it. But people are unwinding risk-on positions and getting more defensive and going away from equities into something else, or going into a small number of defensive positions. And that's usually what causes a lot of these breadth indicators to rotate lower. We kind of get in a fetal position of sorts, and we kind of gravitate to defense, a relatively small number of defensive sort of blue chip, higher yielding names. That causes breadth indicators to come down very quickly. So that's the reality of how the market has changed just from July into August so far. And that, when I think about the likelihood of a further pullback, that's some of the inputs that sort of draw me to that conclusion.
And that, like you said, the end of July, you were at 90%. We're 10 days into August, not even, right?
Yeah.
We've got a ways to go in August.
That's quick. Yep.
That's a pretty quick acceleration. And 90%, that's pretty high, right? Even in a bull market.
One of the higher readings, and if you look back to previous times when the indicator's been up to around 90%, it's random times like February of 2023, which is a pretty significant peak, August of last year, which is a pretty significant peak. So, extremes in breadth are also a very important reading. And the fact that so many stocks were in a bullish phase really speaks to a more mature phase, right? A bullish phase where most stocks now have had their run. So I think while the conditions have changed in August, I think at the end of July, you also saw some of these extreme kind of euphoric signs, which that's the red flag. That's what tells me, all right, start looking for a pullback. And I think what we've seen in August is that sort of manifesting itself kind of in a pretty predictable way if you look at breadth conditions at the end of July.
Interesting. Is it almost to the point, the taxi cab point, right? You get in the taxi and your cab driver's talking about how bullish the market is. That's when you get out.
I was so desperate. So I told you I went to Las Vegas earlier this week for the money show, and I was desperate for one of the Uber drivers to ask me about the markets. I was hoping I didn't get it. I didn't get that validation, but I was like, that would have been so perfect if I could come on and say, yep, I just got asked. But yeah, I think we're at that anecdotal point, right? And so that we always joke, like my college roommate was a computer science major. And anytime my text lights up with him asking about cryptocurrencies, I was like, all right, that's the end of the bull market there. I think you saw that, right? And there's you have to remember that the market rallies in 2023, I think are fear-driven rallies. There's a FOMO that is palpable in the markets these days. And so I think people are so nervous about missing things. And I think that's what really pushes the market higher in July. And now I think you're seeing a bit of if not a good deal of an unwind of that.
Interesting. Well, Dave, we've run up pretty close to time. I know we could talk a lot more about this, but I think, very interesting topic and a great start of the conversation. I think it's a great foundation. And, I can't think of anybody else, like I said before, anybody else who can instruct new traders, people who are new to technical analysis any better than you can. You're probably the one you're my go-to, Dave. So I appreciate you coming on and taking your valuable time and sharing your knowledge.
No, I'm happy to do it, Tom. This was fun. Thanks for doing it with me.
Well, I hope you can come back. Where can people reach out to you? Where can they find you if they want to, see what you're doing and have questions for you?
No, I appreciate it, Tom, and thanks to you, the team at NinjaTrader. I'm really impressed with the show and the work that you guys are doing to really help promote the appropriate use of technical analysis. And I appreciate what you guys are trying to do along those lines. For me, so I'm the chief market strategist at stockcharts.com. We really focus more on medium-term, long-term timeframes and thinking about how the equity and ETF sort of areas of the market are evolving over time. And main thing you can follow me on there is I host a closing bell show every day on Stock Charts TV called The Final Bar. So we're streaming live every afternoon around 4 p.m. Eastern.
Oh, that's great. That's awesome. I mean, people can roll out of bars closing into your show. This is awesome.
Why not? I feel like that's an obvious, why not, right?
I love it. I love it. Well, Dave, thanks again for coming on and just enlightening us. It was really, really good stuff. And want to thank the viewers too for joining us. And hopefully you can join us at 3:15. Michael Burke will put a bow on the week and give his unique analysis, and then maybe get us ready for next week as well. In the meantime, have a great trading day. We'll see you later.